Hello, New Capital clients. I am recording this on the 16th of March. Our family is on spring break, but of course, the markets never rest. And over the last week, we have had a major market event with the bankruptcy of Silicon Valley Bank and the follow-on knock-on effects with other banks as well. So I wanted to do a video and just discuss it a little bit for New Capital clients, help put it in context. And of course, if you have any questions, feel free to reach out to me. Bank runs, bankruptcies have a very long history, going back hundreds of years, really as long as we've had banking. And it has to do with the nature of banking. In banking, the depositors put in money and expect to be able to get that money back at any time. So that is the definition of a short-term loan. Essentially, depositors are short-term lenders to the bank. The banks traditionally then go out and lend the money for a much longer period, often loans to businesses, loans to homeowners. And as a result, you have a mismatch on the liability side of the balance sheet of a bank. Deposits are liabilities. You, as the depositor, can claim your deposit as an asset, but for the bank, it's a source of funding, and a source of funding is a liability, whether it's a loan or a bond or equity raised from shareholders or a depositor. And a deposit is a very, very short-term loan, if you want to think about it that way. So the bank loans it out for a longer period. And if we get a situation where many depositors, huge numbers of depositors want their deposits back today, but the money has been put into other things that the bank can't get the money back, then you have this mismatch problem, and it can cause a bank run and a bankruptcy. And so that is a very, very old problem. It's endemic to the nature of banking. And so it's why banks are highly regulated and highly monitored, but all the same, things happen. So I just wanted to start off by saying that this is nothing new at all. We've had bank runs and bankruptcies for hundreds of years. What is newer, dating only back about 100 years, is the FDIC, the Federal Deposit Insurance Corporation, which is a government institution, but is not really directly funded by the federal government. It's an insurance pool that is paid into by the banks themselves. And it was created in 1933 or 34 with, I don't remember whether it was, we had two major securities acts in the wake of the Great Depression in 1933. And then in 1934, one of those acts created the FDIC, I think probably the earlier 33 Act, but I could be wrong. And that came in the wake of the Great Depression and the enormous number of bankruptcies that occurred in that era. And has really, really been an enormous innovation and a huge help in containing and ameliorating and minimizing as much as possible the effect on depositors when bankruptcies occur. In the case of Silicon Valley Bank, we have a situation that really began to develop during the pandemic. And if everybody will think back just a couple of years, the government was giving money to individuals and to companies to help tide them through the complete halt in commerce that occurred in many different sectors, including the restaurant sectors and the hotel sectors, especially, but not only those, all over the economy as people were locked down for COVID-19. And a lot of those deposits simply went into the banks, and the banks had to do something with it. And in many cases, they did the easy thing with it, which was to buy government bonds or bonds of any kind. And at the time, with interest rates, shorter term interest rates being 0%, the only way that the banks could earn any kind of meaningful return on their purchases of securities was to buy longer term securities, longer term bonds. And that is what Silicon Valley Bank did. The problem is that if interest rates were to rise, then the value of those bonds could become impaired. And if interest rates were to rise very significantly, as they did last year in 2022, many of you know that because your portfolios were down 5, 10, 15%. And so that happened, then the value of the bonds that had been bought by the bank, Silicon Valley Bank, would be down quite a bit. And that would impair the balance sheet. Now, I want to take a little bit of a diversion right now to talk about balance sheets. And when a bank buys securities, there are two different ways that they can hold them on their balance sheet. If the investments, the bonds, are available for sale, then the accounting standard is that the value of the bonds is whatever the current market price is. And every day we at New Capital mark your securities to a market price called mark to market every single day so that your portfolio is up to date. We purchase for you mostly public securities, and really in almost all cases, that's what we focus on. There are lots of investment managers who are trying to get us to buy all sorts of esoteric stuff for you. That one of the big problems with if we decided to do that is that we wouldn't really know the value for a long time. And for those of you who saw Investments 101, we talked about the fact that every year a company has an audit and the accountants say this is what the company's worth, but we know that's not what the company's really worth. It changes second to second, minute to minute, and the market price changes. So the banks have this issue when they have bonds or other investments that they hold, residential loans, for example. If, however, the bank is going to hold the security until it matures, hold the bond until it matures, it is what is called a held to maturity asset. And in that case, the bank does not have to mark the investment to market, does not have to put onto the books the investment at a market value, can carry it at whatever its cost basis was, whatever it was purchased at, unless there has been some revaluation that has been done on some appraisal basis. And that is exactly what has happened with Silicon Valley Bank. The bonds that they bought, let's say back in 2020, during the pandemic, in 2020 became impaired, but the bank did not have to write down the value according to accounting standards. And so it wasn't until recently that the market started to see that those bonds were not worth what Silicon Valley Bank had bought it for. And when that news started to make its way to the many depositors of Silicon Valley Bank, many of those depositors being startup companies. That's the specialty of Silicon Valley Bank, startup companies that may have raised millions of dollars from venture capitalists or from individual investors or angel investors to get their operations going. And where did they take that money that they had raised from startup shareholders and venture capitalists? They put it into their bank accounts at Silicon Valley Bank. And as many of you know, one of the things that the FDIC does is it provides a insurance umbrella, but only up to $250,000 per account. And so you have many companies who bank at Silicon Valley. I myself have been involved with some startups, and their accounts were held at Silicon Valley Bank. It was one of the specialties of this bank. Many startups may have millions of dollars or tens of millions of dollars in deposits. And so for the early days of this crisis, those depositors were completely freaked out as to whether they were going to even get their money back. And thankfully, I think the president and the Fed and the Treasury Secretary, I don't remember the exact mechanism, but if this particular group gets together, they can actually decide to extend greater compensation, or rather greater coverage, so that depositors get their full amount back from the FDIC, and then the banks have to pony up more money to cover that insurance pool. Now, this is being called a bailout, right? This whole incident with Silicon Valley Bank has gone political, but it's not really it's a bailout of depositors. And who in this country doesn't think that somebody who puts money into a bank shouldn't be able to get their deposits back? Silicon Valley bankrupt, will go bankrupt, is going bankrupt, is being walked through bankruptcy with bankruptcy attorneys. And the shareholders of Silicon Valley Bank will go bankrupt. There's no bailout that's going to occur for Silicon Valley bank holders. The bank is not going to be saved the way that a bunch of banking institutions were saved back in 2008. And even that was a fraught period. Lehman Brothers went bankrupt, right? That kicked it all off. And then others were either saved. Morgan Stanley and Goldman Sachs were given capital. Actually, they were forced to take capital. JP Morgan was forced to take capital. And then other banks in 2008 were forced to be sold. Washington Mutual had to be sold, and Bear Stearns had to be sold. So they're trying to do the same thing with Silicon Valley Bank, which is sell what they can of the bank. But the shareholders are more than likely are going to be wiped out, and bondholders will be wiped out as well. So I don't see this as a bailout to make sure that the depositors get their money. And I think the president and the Fed and Treasury Secretary have done the right thing there. You're free to disagree. I'm just giving you my opinion. I don't see that as a bailout so much as an institutional imperative that we protect depositors in this nation. Now, how broad is this problem? Well, Silicon Valley Bank would not have been the only bank to have bought longer-term bonds during this period that I'm describing, where deposits rose very significantly. And we have seen that the market doesn't think that it is only Silicon Valley Bank. We have seen the stocks of other regional banks sell off. We even over the last few days have seen European banks sell off, even some of our larger banks like JP Morgan Chase, which is the largest bank and by assets in the United States. Its stock is down. And so the market appears to be saying, we don't think that this problem of impaired bond values being held in the asset portfolios of banks is only going to be limited to Silicon Valley Bank, but we don't think that it's going to result in a bankruptcy. In other words, what's happened with Silicon Valley Bank seems to be an extreme case, and we've seen stock values move up and down from day to day, and we'll see. I can't tell you about how broad the problems are, because I don't work inside those banks, and I'll talk about that being inside banks and how do we approach it ourselves at New Capital in a few minutes. But I want to turn right now to talk about shareholders in Silicon Valley Bank and other banks as well. I told you that in all likelihood, the shareholders in Silicon Valley Bank are going to be wiped out, not the depositors, but the shareholders will be. And you and I are shareholders of Silicon Valley Bank. Did you know that? The mutual funds that we purchase for you contain Silicon Valley Bank. One of the main ones we use is the ticker symbol DFAC, the DFA US Core Equity 2 fund. Now, before you get too upset about that, let me tell you how much Silicon Valley Bank counts for in DFAC. DFAC is about a $15 billion mutual fund. All right, you got that? $15 billion. And as of the beginning of the year, if you check, and I checked the reports that are regulatory reports that the mutual fund has to file quarterly, showing what its positions are. which is a very, very good thing regulatory wise. I highly support it. It means 4 times a year, your mutual fund has to put out an official version of what its holdings are. And Silicon Valley Bank at the beginning of this year accounted for $23 million in DFAC. Not nothing, but a fraction of a percent. Fraction of a percent. This is why we diversify you. This is why we don't want to hold any one company stock, because you just never know. Silicon Valley Bank is not a centuries-old bank like JP Morgan. It's only 40 or 50 years, but it has a very, very prominent history. It has been the main banking institution in Silicon Valley, which is why it's called Silicon Valley Bank, and has been a critical financial institution for that industry and in that part of the world. And I can tell you that plenty of people held concentrated positions in Silicon Valley Bank and they lost their whole position. But this is exactly why we at New Capital do our very, very best to diversify you. Now, Silicon Valley Bank accounted for 23 million of 15 billion. You can imagine that we also diversify you internationally. And so that $15 billion position, which is US equities in a portfolio that is a global equity portfolio that we put together for you, might be 15 billion in US equities, and the proportion for international equities might be 10 billion, right? That's the proportion, sort of 15 to 10. And so from that perspective, in your full equity, global equity portfolios, that Silicon Valley holding would then be on a proportional basis, 23 million to 25 billion. 23 million to 25 billion. And then if we assume that many of you hold quite a bit of bonds, let's just say 60% of your portfolio is stocks and 40% is bonds, then we might say with the 25 billion, we would add another, let's just say 15 billion in bonds. So it would be a $40 billion portfolio. 23 million would have been Silicon Valley Bank on a $40 billion notional portfolio. And you can see that the effect on your overall portfolio by this one bankruptcy resembles really the not to be crude, but it's like the gnat on the butt of an elephant. And that is, I think, why New Capital has not received a single, over the last week, I have not gotten a single phone call or a single email from any client highly, highly concerned about this particular episode. 23 million to 40 billion. That is the impact of Silicon Valley Bank. And that is what we tried to do for you with your portfolio so that you can sleep at night. And apparently clients are sleeping because they're not calling me or emailing me. I want to turn now to talk about cash. And I think this is the last thing I'm going to talk about in the video today. This whole episode with Silicon Valley is causing people to think about how they hold cash. And clients ask all the time, you know, what about cash? Can you guys take care of cash for us? And we take care of cash all the time for people. And people ask, well, should I put it in the bank? And I have it in the bank. And should we give it to you? And I'm just going to say that I have never been as comfortable putting my cash or cash equivalents into a bank as I am putting it into our portfolios. And the reason is, again, diversification. If I take my cash and put it into a single bank on deposit, I am at the mercy of the board of directors and the loan officers and the executives of that bank to do the right thing with my deposit. Maybe they will, but maybe they won't. Maybe I got unlucky and put it in the one bank or the two or however many banks, the 10 that go bankrupt each year. And even if my account is insured up to $250,000 and I've only got 200,000 in the bank, it's still kind of a nerve-wracking thing. I can tell you that all the depositors that that had cash deposits with Silicon Valley Bank and were under the $250,000 FDIC cap, it still wasn't a very fun week for them. So we have several methods for handling cash at New Capital, and I think increasingly in the wake of the Silicon Valley bankruptcy, clients of wealth managers are going to be looking to wealth managers to protect their cash. We've always done that, but this is just one more thing. And the reason is because what we put cash into are funds that are backed by treasuries, or very short-term, ultra short-term corporate bonds, which are highly diversified. No one company accounts for all of it. Now, they don't react exactly like cash. Cash is a dollar bill in your pocket or a $20 bill, but you don't earn any interest on your dollar bill unless you put it on deposit somewhere. If it sits in your wallet, there's no interest to be earned, and people like to earn interest. Your cash, by default, is held at Fidelity in a mutual fund, a money market mutual fund, FDRXX. Again, the symbol is FDRXX, Foxtrot, Dog, Rainbow, X-ray, X-ray. A money market fund is simply a bond fund that is an ultra short-term bond fund, where the maturities are maybe 1 week. It's a mutual fund composed of bonds that are coming due in a week. And this particular bond fund is a US government bond fund. Some of the holdings in the fund are treasuries, but not all. Some of them are obligations of Freddie Mac and Fannie Mae in the mortgage market. Those sorts of US government obligations, but they're only 1 week to go before they come due. And so that is where cash goes by default in our accounts. Over the last year, New Capital has created 2 other cash and cash equivalent models. We have our TCM model, Treasury Cash model, which is 100% backed by US Treasuries. Right now, it has a duration of about 45 days. So it's got a little bit more interest rate risk than the money market fund, 45 days versus 7 days. And it has a yield of about 4.5%. And it's backed fully by treasuries. And then lastly, we have the enhanced cash model, ECM, which is about 50 or 60% treasuries, I forgot which. And then the remainder of it is short-term corporate bonds, which are going to come due. It has a duration of about 100 days and a yield of maybe 4.6, 4.7%. So we are happy to help you if you have decided that you really don't want to keep cash in the bank. And I'm not telling you you shouldn't keep cash in the bank. We have FDIC insurance for that purpose, to encourage people to hold cash in the bank. But if for whatever reason you've decided that you would rather hold cash in your portfolio, which is what I do, because I don't want to put my cash in the bank for the most part, I'd rather have it backed by treasuries and a broad portfolio of ultra short-term corporate borrowings than to hand it to a single bank for them to do what they're going to do with it, even with the insurance. We are happy to help you with that. Our interests are to make sure that you have excellent diversification, that you have excellent liquidity, and that you have excellent safety. All 3 of those things: diversification, liquidity, and safety with your cash holdings. And that is exactly what we do. So if I can help you, or anybody here can help you discuss either this issue with Silicon Valley Bank or your own cash holdings, please let us know. Send me an email, shoot me a call, and I hope that this video has been helpful to you in helping you understand your portfolio and how it relates to the Silicon Valley Bank bankruptcy. Thank you very much.